Exxon has an 8.5% dividend yield. Let's dive into this. So good morning. It's an early morning here at the household. My routine is I usually get up 5:15 or so at the first bark of my little dog there, and he usually lets him know it's time to go potty. So I let him out, get my cup of coffee. I grind up some Holler roast coffee from Nicole Sauce up in Tennessee, and you can find her Holler Holler roast coffee from Living Free in Tennessee. I do not get paid to sponsor or anything like that. I grind it up and put it in my French press, and that's what I'm drinking. All right. So sometimes I don't even get a chance to shower or shave or anything. I just if I get something that's interesting to me, I just got to get off my chest. So I'm sorry. I'm sorry. I just I look at this. I got to get to this because it's like I'm like a dog, man. I'm like squirrel, squirrel. And that's what I am. So I said, all right, I got to get off. So let's dive into this. Sorry about the appearance. I'm not really all that sorry, but anyway, if you're offended by the lack of professionalism, I don't know what to tell you, man. You must be new to my channel. So I was going through I was looking at my stream here on my phone. I was just like, I cannot believe Exxon has been removed from the Dow in favor of Salesforce. That does not make any sense. I mean, they can do whatever they want, but I'm looking at my stream on my ticker here. You know what I'm saying? I'm just going through it. I said, what is the price of Exxon? And I was comparing it to Salesforce. And I said, this is just weird to me. So Exxon is trading at $40 a share. It was down $1.34 yesterday. It's the 52-week low was 30, and right now it's at 40. So it's 30. It's up. What's that? 33% off its 52-week low. But you know it was down from just the other day. It was at 60. What was it here? It was at 53 just on June 1st. So it's gone down $13 in a month, in almost 2 months. So $15, $13 divided by 40 is down 32% in a month and a half. I'm like, that's just odd to me. Has a PE of 24, but then what hit me has a market cap of 172, so that was interesting. But then what hit me, it's got a dividend yield of 8.5%, 8.51. I said, what? So let's look at this. I haven't dived into the financials yet, but someone asked me the other day, how do I look up financials? So I just always start with Yahoo Finance. Look, and people, and I've talked about it, I don't care. I look at Yahoo Finance. So let's take a gander at Exxon. All right, so we're going to look at Yahoo Finance, and we're going to first look at this. This is how I research a stock. If I were to buy one, this is what I want to see. So we're going to look at, hold on a second. There you go. Go see Liam. Thanks, buddy. You can see him. So basically what I'm doing is I'm looking at what the price. So basically it's gone from 77 down to 40 in the last 5 years. Max. So you can see, I don't want to go max. Let's go, can we go 10? Let's go, no, either way. I guess we go max here. We go right there. All right, so 2000, we don't want to go there. We're going to go there. So base has gone from, it's about half price from what it was. Now, just because it's half price doesn't mean it can't go down more. I cannot stress this enough. And that's why I did a video yesterday on can't go bankrupt if you got no debt. But when I'm sitting there thinking, okay, so Exxon is down to $40 a share. Has a PE of 24, so it's making money, trailing 12 months. All right, actually making money. It pays $3.48 a dividend. So it has an 8.5% yield. All right, so now the question is, the first thing that jumps out is what is the likelihood it can continue to pay that dividend? And what we got to see is how much debt do they have. I mean, that's the issue. I imagine Exxon's got a ton of debt. So we want to see if there's anything that says anything about Dow paying its dividends. So we're just looking through we're just looking to see anything about the dividend, that if ExxonMobil has anything where it's going to stop paying its dividend. And nothing jumps out at me right quick. All right, so I don't see anything on dividends yet. Again, this is just basic information here. I haven't looked at it yet. There is a website someone had told me about dividends, and I just forgot what it was. So I'm not going to look at that right now. Anyway, so the first thing I want to do is I want to go to financials. I want to see how much debt is it carrying in order to pay the dividends. So remember, they got earnings. They're making $25 a share of positive earnings, all right? So they got cash flow, positive cash flow. So now we're going to go down, and I just want to see the balance sheet. and we want to look at assets, liabilities. All right, so we're going to look at liabilities here. So they got $163 billion, or is it? Yes, $1 billion of liabilities. All right. How much cash they have on the side then? And that's gone up from 100. So it hasn't really increased their debt that much in the course of 3 years. So the course of 4 years, they've gone from 156 billion to 163 billion in liabilities. So in of itself, that's not horribly alarming. Current liabilities have gone up. Non-current liabilities, let's see, long-term debt, there we go. All right, so their non-current liabilities, long-term debt, 20 billion. Well, thanks, buddy. Oh, there's Pablo. All right, so they got, don't forget when Pablo makes an appearance, you got to paw the like button. So you got 27 billion of, and it's actually gone down. Their long-term liabilities are 25 billion essentially. Deferred tax liabilities, 25 billion, which is down from 34 billion a couple years ago. So their long-term liabilities are 100 billion. Okay, that's interesting. So I'm just keeping that in the back of my head. 100 billion of long-term liabilities. Their current liabilities is only 20 billion. Accounts payable, 20 billion. All right, so let me tell you what deferred taxes liability. So, like for instance, I'm self-employed. I got to pay estimated taxes. My estimated taxes, I know for this quarter, are going to be through the roof because it's been insane busy this last couple months. So I have a liability on the balance sheet called estimated taxes have to pay. I know that for a fact. I know that I got in my head, and it's in the 5 figures. So that is that's a liability. Now that is for me, is a current liability. They got taxes payable. That's mine, taxes payable. Theirs is a non-current liability, long-term liability, deferred taxes liability that they have to pay. So that's interesting to me. So their current debt is only 20 billion. Accounts payable is 25 billion. So that's all money that's going to go out the door right out the gate. 45 billion. So that's interesting. So 45 billion of current liability. So now we're going to go to assets, and we're going to see how much cash they have on the side. And so the receivables are going to cover their payables, which is somewhat scary to me, but that's okay. And when I say somewhat scary, because receivables are always, you start going 30, 60, 90, and then you start going 180, and you can start writing off receivables. And if you're expecting your receivables to cover your payables, and then the receivables don't get paid because your vendors are going bankrupt, you could be next, if that makes sense. So receivables and payables, as long as they kind of cover each other, I'm somewhat fine with that. The problem I have with that, of course, is that if you can't convert your receivables to cash. Now, there is something that Exxon's not going to do this, but there's something called factoring, where if you're a smaller business, you can go to your bank and basically get paid for your receivables and essentially turn over your receivables to a bank. They'll pay you 35 cents on the dollar, and then they'll go to collect your receivables. So ExxonMobil's not going to have to do this, but I wonder if I can find my article I did on factoring. I had written an article for the Shenandoah Valley Business Journal on factoring. I want to see if I can't find that. It was freaking 20 years ago. All right, so anyway, they got $3 billion in cash, and so the cash doesn't cover their current liabilities, pretty significant cash. Their current ratio is significant. Cash to current liabilities. That's not good. So basically, their current assets are quite low. All right, so they got $3 billion in cash, 21 billion in receivables, and 18 in inventory. Inventory you can't convert to cash just like that. So that is the only thing they have right there for their current cash is $3 billion bucks. Total, let's see, non-current assets. Yeah, so that's the issue. Their property, plant, and equipment is 250. Again, you can't convert that to cash. All right, so that's they don't have much cash relative to their current liabilities. That's a concern of mine for sure. So they don't have much they can convert into cash immediately, and because of that, that's a concern. So now we got to look at the balance sheet and see what they're. All right, let's see total liabilities. All right, good stockholders' equity. Let's just look at here. All right, retained earnings. All right, there you go. That's pretty good. All right, good. All right, so let's see what their income statement looks like. All right, so their income, their total revenue, trailing 12. Let's look at 2019. 255 is their gross sales, essentially gross receipt. Cost them $200 in order to make those sales. So it basically made $255 billion of revenue. And then it cost them $200 billion to get that 255. So they made 55 billion in profit. Operating expenses of 43 million. So they made total right there $12 billion in profit. So now we got to find out how much their dividends cost. Let's see here. Income before taxes, tax expense, net income. So net income available to 14 billion of net income available to common shareholders. Earnings per share 3.3 billion. Gotcha. Earnings before interest, taxes, debt, and amortization. All right. So basically, what we're saying is we just want to look at net income available to common shareholders. All right. So we want to see how much they paid in dividend payouts. So let's. I don't think it's on the income statement. Income available. Okay. So let's look. We're gonna go to cash flows. I just want to make sure they can afford to continue to pay that dividend. That's all I want to see. Cash flows from investing, operating activities. Net income, 14. All right, gotcha. Deferred income taxes. And so that goes against their income. The deferred income taxes, $1 billion right there. Other non-cash from investing activities. Where is their debt? I can't remember. Other investing, financing activities, dividends paid. All right, so $14 billion of dividend paid in 2019. 13.7 billion in 2018, 13 billion in 2000. What was that? 17 and 12. I see. Look at those dividends paid though. Those dividends are going up by 12.4, 13, 13. I mean, they're increasing their dividends by. See, that's man. So let's see. 13 billion. They went from 13.7 minus 13 divided by 13. They went 5.5% increase in dividends right there in those years. They went 900 divided by 13.79. They went 6.5% there. I mean, they've increased their dividends significantly each and every year. Look at that, man. So there's their dividends paid: 14 billion, 13 billion, 13 billion, 14.5 billion, 13 and 7 billion, 13 billion, 12.5 billion. All right, so they're paying that, and their cash, their I want cash. We want to look at. Hold on just a second. Dividends paid. Okay, let's go back to income statement. So we want to go look at here. How much net income? So look at that, man. They look. All right, so this is 2016. They only had $7 billion in net income available. So they had a bad year that year. So their earnings per share is $1. 2017, their earnings per share jumped by basically 300%. 2018, it didn't jump up that much. 2019, it went down. Right? So that's a concern. But I mean, 2019 was a bad year for earnings. So look at that. They made $7 billion in 2018 net, 19 billion in 2016, 17 net, 21 billion in 2018 net, 14 billion in 2000. So they're making money. So we got 7, 8, we got 8, 20, 21, 14. 8, 20, 21, 14. All right, so let's go back to the balance sheet. Let's go back to assets. We want to go to current assets, look at cash. Yeah, so they had 3.6, 3.1, 3.0, 3.0. So they haven't burned through their cash. And let's look at liabilities. Look at current liabilities. Yeah, they're actually current liabilities have gone up. Okay, that's a concern. So the current liabilities have gone up from 47 to 63 billion. That's basically the extent of the dividend they just paid. But their non-current liabilities have gone down by to 8% or so. I mean, so there's no reason to think that. Oh man, I mean, look, I'm not saying you should buy it. I don't know, but there's no, but they make the cash flow to cover their dividends, and that's net after, paying the debt. They make the cash flow to cover their dividends. It's just all there is to it. And their dividends have been increasing each and every year. Their earnings per share has gone down. Yeah, I tell you, man, that's of interest to me. Let's just see analysis. And I don't trust these analysis as far as I can. I mean, look, it's interesting to see before you buy a stock, just see what other people are saying, but don't throw in and say, "Oh my goodness." Yeah, so earning per share is dropping, but that in of itself, that doesn't bother me that much. I just want to see the freaking growth estimates in the next 5 years are 12.91%, where the last 5 years is negative. Well, that's because energy. Oh man, I don't know, dude. That seems to me to be earnings history. All right. I just want to see if they can keep the so the issue is if they can keep the dividends. Let's see if we got any. Do we just look at statistics? So the forward PE is 121, so it's through the roof. Because again, we're looking at trailing 12 months. So their forward PE is 121. Let's see what that's based on. And I don't see. Oh, data provided by Thomson Reuters. Hold on. Pablo. So basically, they're saying, look, the projected earnings for these guys are going to be way low relative to the price. But in price, price to book. Look at that. Look at that. Most recent quarter is 0.96. Yeah, I mean, look, I'm not a stock picker. I just look at this. As long as you got the money to pay the dividend, you're sitting there you're waiting for it to go and you're getting 8.5% yield. 8.5% yield. As long as they got the profits to pay the dividend, you're getting that 8.5% yield, regardless of forward PE ratio is. I don't know. Look, I'm not telling you what to do. I'm just saying at the end of the day, you're getting paid well to sit there. The price to book, if they were to liquidate everything today, you're making money because they have more. Oops, thanks, bro. You have more assets than the liabilities. So you got to look. I'm just looking at PE ratio. PE ratio right now is low. 25. It's not low, but it's real low relative to freaking Salesforce, which replaced in the Dow. They got enough revenue, cash. It seems to me to cover their dividends. Their positive cash flow. The price to book is absolutely fine, without question. It's not through the roof. Now, a lot of that's inventory. I get that. Real estate, I get all that. Manufactured plants, and that's all tough to liquidate, but still. Energy has been hit hard. They haven't taken on a significant amount of debt in which to pay that dividend because they can do it through operating expenses. So I don't know, man. Seems to me if you're getting paid 8.5% to sit there, you could sit there a long time and just reinvest those dividends into more shares. And if it never goes up, if it stays flat, you're still getting paid. As long as they make the positive cash flow in which to pay the dividend, I just think you're going to be in a good place. You're going to have to do your own research. All right. Love to hear your thoughts on that. See ya.